the big conversation today is with regard to Ugro Capital. Why is it big? Is because they've done a large fundraise. Now, for an 1800 crore market cap company to do a 1300 crore or announce a 1300 crore fundraise is certainly extremely large. And for that, we have with us Mr. Sachindra Nath to understand as to what this is all about. And this is an exclusive chat with NDTV Profit. So thank you so much, Mr. Nath, for taking out time and coming in and speaking with us live from our studio. So I want to first start off, explain the dilution to us, because it's a large dilution at sub one-time price to book. So explain, one, the dilution itself, what was the thought process behind it, plus you've done some instruments in June of 2024. So when I'm combining those two, the dilution is very, very large.
Yeah, no. So thanks for giving the opportunity to explain. I think it's important for everyone to understand that why we have done it and what's the method. So look at this way. We were at around 6,000 crore of AUM in 23. We were at 9,000 crore in 24. In June of 24, we raised total capital commitment of 1,265 crore, of which around 250 crore was in form of equity, and we did 1,000 crore worth of warrants. That was done at a price of 265 rupees. And those warrants conversion is in the month of December. Every time when we reach near about 20% of capital adequacy, philosophically we raise new capital so that it continues to give comfort to the lenders, to the regulator, and we continue to do our growth because this company is growing, sequentially. Sure. So we reached around 19% capital adequacy end of March 24. When in December, if these warrants would have converted, then we would have reached back to 26, 27% capital adequacy. What we thought that given that now traded price is much below the warrants, the possibility of warrant converting and not converting depends upon the share price. Now we are an operating company, and as an operating company, our capital cannot be dependent just on share price. Sure. So we thought that it would be very good that we go back to the investors which have invested in the warrants and give them the option to infuse, the same amount of capital in the company now. They benefit from the price. We benefit of locking our capital today and continue on our growth journey. So that's the logic. So I don't think so you should look at this double dilution. You should look at this as a replacement dilution of, against those 1,000 crore of warrants, we have now issued fresh capital of around 915 crore. We had to do a right issue because we wanted to be equitable and fair to every shareholder. So the incremental dilution, if the same warrants would have converted at 265, which now money is coming at 185, leads to around additional 4% dilution. So we have done a right issue at the same terms, so that every public shareholder also have the opportunity to invest in a growth company. And that's a little bit of additional capital. So my presumption is that this is the same dilution. At that time, we were diluting 25%. This time, we are diluting 30-odd%.
Point taken. So sir, you're giving benefit of the lower price to institutions. Of course, they had the option of subscribing to the warrants or not. How much of the warrant money did you receive upfront? And isn't it ideal that you ought to have raised equity back then, therefore, at 265?
Yes, ideally, yes, of course, why not? So look, in June of 24, when we raised that capital, you'll remember that was a point in time where multiple NBFCs were getting banned. Market sentiment around NBFCs were very hostile. And that's why we, raised what capital was required. So we raised 250 crore of equity. We raised 1,000 crore of warrant, of which 25%, which is 250 crore came, and 500 crore got added to our net worth. Investors were also, making a choice that in a very, turbulent time, they were taking the optionality of giving us the money, but they were protecting, their risk. And look at what has happened that, since then the market and NBFC market have come down, and our prices also come down. So they made that choice of taking that risk, and we raised capital through that structure. And that's okay. And from now, but if you look at our operating performance, we have delivered what we have promised. We have moved from 9,000 crore to 12,000 crore. We have moved our profitability, our ROEs have improved, ROE has, because of the capital raise, has not gone up further. We have delivered high credit quality. So in fact, there's a lot of narrative. In the morning when I woke up, I was reading, people said, oh, like microfinance company, this company is raising so much of capital, there's big, problem or NPA is coming up. Think of this way. Two of our, largest institutional investors, Danish government, which is, sits on our board, is committing 150 crores. Samina, which is existing 7% shareholder, sits on our board, are putting 500 plus 150 crore of capital. Why in the world and two, global institutional investor would put more money into the company if they will not see the growth potential or they will see trouble in the company? Nobody does that, right? Because
is there a concern, sir, from some of these investors because your stock has taken a bit of a beating? You used to trade at 1.3, 1.4, at peak even 1.5 times book.
Yeah.
And I'm talking trailing 12 months. You're currently trading sub 1 time.
Yeah.
So is there a concern that any of these investors have expressed? Is there a due diligence which they've done, they've spoken to you about?
So no, so that's what I'm saying. If you look at of the total current capital which we are raising, almost 60% of that is coming from investors who are, on our board actually,
Sure.
right? So they see and look at this company on an every quarter basis. So obviously they are super confident, and that's why they are using their option to double up on their investments. Second, I think so it is the market price, in my presumption, sometimes it's very hard for broader market to differentiate. So in a market scenario wherein SFBs, microfinance companies, there's so much of happening around that. I can keep saying that MSME financing, we keep saying this tagline, MSME अच्छा है, बिल्कुल अच्छा है, but for broader market to then pinpoint and say, no, this company is really different, sometimes it's very hard for me to control that narrative. Over a period of time, I think so we have to deliver what we have to deliver, and market would react to that. But financial institutions, whether they are bank or NBFCs, if they are independent, have to raise capital to make sure that capital for growth, for capital adequacy and lenders' comfort remain with us. And I think so we have ensured that. We are hopeful that this size of capital raise would improve our ratings, will reduce our cost of borrowing, and our operating performance would continue to improve. We have invested very, very heavily in our operating infrastructure. In last year itself, we have added roughly around 100 plus location. We are at 270 plus location. Our emerging market channel is growing. We are super confident that over the next 2 years, we will deliver a very high-performing business and will continue to grow MSME financing in India and make this as a leading MSME financing player in the country.
I take your point on that, sir. Sir, tell us, you've spoken a couple of times about how the dilution is just 4%.
Extra 4%.
Extra 4%. So you're saying versus last year's dilution, the dilution will just be 4%, but that's the base case. That is if the stock doesn't rebound.
Yeah.
If the stock does rebound, then dilution will be far more.
Yeah, of course, it would be. I hope so that you're right. I hope so stock rebound, and there are two parts of it. If it rebounds and the warrants are still alive and if they get exercised, that would be an additional capital to company at a higher price.
Sure.
Number two, I think so within our warrant holders, there are, Samina is 50%, right? Post this round of CCD, they will touch roughly around 21%. And as you know, institutional investors don't want to cross 25% because they will trigger open offer and so on and so forth. Sure. There is another investor which will cross touch 5%, and as an institution, they don't take more than 5%.
Okay.
And I can't commit on their behalf, but my presumption is that even if theoretically the price goes much beyond the warrant conversion price, some of these investors won't be able to convert. So there will be not additional dilution. And whatever is left, roughly around 200-300 odd crore, even if it comes, we are a very high growth company, right? We should be able to, take that benefit of that capital and deliver, optimal performance to that capital.
Point taken. Sir, you've gone from 19% capital adequacy to 29. You're, of course, leaving scope for another 200 to 300 crore of possible equity to come in if at all things were to become more favorable in terms of the stock price move. So what happens to your capital adequacy then? And how long will this 29% capital adequacy last you? Because you're fast growing.
Yeah. No, so I think so, look, there are last 3 years, we have focused on building the franchise for size, which we have now delivered. Every year, we have added roughly around 3,000 crore of AUM and around 1,500 crore of on-balance sheet asset. We have the capacity to go even beyond that. But right now, for this year, also we will grow at the same pace. So I think so we will add another 3,000 crore of total AUM, add another 1,500 crore of our balance sheet. But we have channels and capacity. So we will, I think so at the end of FY26, we should end up at around 24% of capital adequacy, which means we have another, 6 to 9 months of growth momentum which will come. And gradually our ROEs would start improving. So our need of capital, if you grow at 25% and if your ROEs are in 15%, then capital gap is around 10 odd percent. But that would keep improving. So our need of capital would keep coming down because your accreted profit would go up. But even if more capital would come, we have the distribution capacity and the liability capacity. So our emerging market business, our embedded financing business can be accelerated at any given point of time. We have to calibrate our growth. Right now, we are trying to give in we are trying to manage or give a very predictable growth targets. Company wants to grow at 25 to 30 odd percent, and our core focus is now to improve our return on asset and return on equity. Return on asset would be first, and return on asset is also a function of our cost of liability. Our cost of liability vis-a-vis our peer set is roughly around 150 basis point higher. It is just because of our size, speed, no single parent on top of us. But with this capital, we think so that would also improve. So we are in a very good cycle. Rate cuts have happened. Along with rates cut, with capital raise and hopefully a rating upgrade, that should lead to a better ROA is our expectation.
Is the rate pass-through going to happen in your case? Or will it accrue to you?
Yeah, it will. Some of that would get passed through, but some would so there are two ways to look at it. I think so. One is what rate benefit that come to us because of the cut. That takes around 12 months. But more so, new borrowings which we'll do would be much lower because when you are at a 30% capital adequacy, you don't pay the lender the same price. You pay much lesser. So incremental borrowing would come at a lower cost.
Point taken. So absolutely any concern with credit quality, as you correctly said, there was some concern at least within certain pockets in the analyst community that is this possibly an issue with regard to credit quality? Are you willing to absolutely come out and say this is not a problem with regard to credit quality whatsoever and that you're absolutely clean in terms of book?
So there are two parts to it. One, maturity of the portfolio. We have designed Ugro for a total credit cost of 2%. And we have designed our different asset line for certain level of GNPA. So our prime business operate at a secured air operate at a GNPA of 2%, business loan at say 4.5%, micro enterprises at 3%, embedded financing at 1%, and machinery at 1%. By maturity of the portfolio, definitely, some of this would flow. We are at 1.5% of credit cost. As the portfolio will mature, it will hit 2%. But beside that natural progression, we don't have, and I can tell you with a certain amount of commitment, we don't have ballooned NPA which has not been disclosed. We don't have to take massive write-off. So take my words for it that if somebody thinks that I can raise institutional capital to take a future write-off from set of the same people who are in the company, that's not right. I think so. We will continue and we will make changes. I think so. The market continues to change. So, for example, business loan segment we felt is under pressure. We have brought down its volume from 225 crore a month to now 75 crore a month. We would make corrective changes to reconstruct our portfolio, but we would be in the range of around 2.5% of gross NPA and around 2% of credit cost. And we will try to make sure that we will deliver consistently over a long period of time.
Thank you so much, sir. This has been a good conversation. It's been a tough conversation, but you've been candid, so I appreciate that. Thank you.